Today, we're not just looking at a financial chart.
Yeah.
I mean, we are wading right into what feels like a crisis point in the leveraged asset space. We're going to be dissecting a financial analysis report that makes a pretty bold argument. It says that the moment everyone else hit the panic button, well, that might actually be the moment a huge opportunity was born.
It's a classic contrarian setup. I mean, it really is. The asset we're focused on is BITU. That's the ProShares Ultra Bitcoin ETF.
Right.
And it has just taken a brutal, brutal beating. So while most traders are seeing nothing but red, this analysis is positioning itself to answer a really high-stakes question.
Which is?
Is this steep sell-off the ultimate buy signal?
And the numbers that sparked this entire deep dive are, frankly, startling. BITU recently just plummeted. It set a fresh 52-week low of $21.55.
And it did so right around Christmas Eve.
Exactly. So you have maximum emotional pain lining up perfectly with the structural low in the chart.
And that combination, that's what fuels this whole thesis. You have to understand, when a high leverage product like this hits its lowest point in an entire year, what you're seeing is just pure, unadulterated fear.
Okay.
So our mission today is to really unpack the precise high-risk, high-reward strategy that's outlined here. We're going to detail exactly what a trader needs to see for a bullish reversal to, even have a chance of materializing.
And crucially, we need to know where that line in the sand is drawn. The analysis we have points out that at the time it was written, the price was hovering right around $22.01.
Yeah.
You were talking about razor-thin margins, literally cents above the absolute low.
Indeed. And I think we need to start by defining the source of the panic before we can even begin to appreciate the opportunity.
Okay, let's do it. Let's unpack this setup. So the report opens by confronting what it calls the ugly truth. Basically, the reason why market sentiment is so dominated by sellers right now. And it's undeniable if you just look at the stock's history over the last year. The picture is incredibly bearish.
Oh, it is. It's entirely rational to be fearful.
Yeah.
When you look at that 52-week range, you really start to get the magnitude of the fall. The high point for the stock was $65.73.
$65.73. And we're now down at $22.01.
Yeah.
When you put that into percentage terms, I mean, that's catastrophic.
It is.
The stock is roughly 66% off its high point.
Exactly. And for anyone who isn't, a long-term believer in the cyclical nature of Bitcoin or who doesn't really understand these leveraged products, that is not a correction.
No.
That looks and feels exactly like a crash. That's like seeing 2/3 of your asset's value just vanish in a year. The psychological damage is immense. And that's what drives this kind of indiscriminate selling.
And the analysis stresses this isn't just, old news. This is real-time tension. The market was confirming this downside when the analysis was written. It notes the stock was still down, 1.01% on the day?
Right, closing at $22.01. And that daily close, it just reinforces the feeling that bears are absolutely in control. It tells a story of persistent pressure, not some subtle reversal.
So it sets the stage perfectly.
It sets the perfect stage for the contrarian argument, which is, the more certain the market is that the price is heading to zero, the more likely it is that the selling is just exhausted.
So, okay, if the emotional data is screaming sell and the historical data is screaming crash, how much faith can we really put in technical concepts? This is where the analysis gets, I think, truly fascinating. It argues that when maximum fear is present, that's exactly when the opportunity emerges.
That's the core of the strategy. The whole thesis rests on this idea that the selling volume is about to completely dry up, which would lead to an immediate technical bounce. They cite two major concepts here. The first one is pretty straightforward: extreme oversold conditions.
Meaning like the RSI, the relative strength index, or other indicators are just signaling a bounce is due.
It's more than just due. Hitting a fresh 52-week low, the absolute lowest price point in an entire year, that often acts as an overreaction point.
Right.
The market has literally priced in the worst possible fears. That level itself can trigger a kind of reflexive buyer response.
But the analysis isn't just waiting for the low. It's specifically looking for something called the capitulation wick.
Yeah.
What is that? What's the actual tangible technical marker that separates a failed trade from a successful rally?
The capitulation wick is the specific marker they're trying to catch. The best way to think of it is like a coiled spring.
Okay.
The price drops and drops, and the wick is that one moment the spring compresses to its absolute maximum. It just can't compress any lower.
And so it's ready for the snapback.
Instantly ready for that sharp snapback.
So it's basically identifying the final desperate act of the sellers.
Precisely. It's that last aggressive burst of selling that pushes the price to the low point of the trading candle, only for buyers to immediately step in and push the price back up within that same period. It tells you the selling pressure was intense, but it was fleeting.
The sellers ran out of ammo.
They ran out of ammo right at that absolute low.
And this whole idea that the potential magnitude of that snapback, it's amplified by the nature of the asset itself. which is just crucial for listeners to understand. The leverage factor.
Yes, this is the double-edged sword that defines both the risk and the reward here. BITU is a leveraged ETF. It's designed to provide amplified returns relative to its underlying asset, which is Bitcoin.
So if this capitulation wick is confirmed and we get that relief rally, what does that 2x leverage actually translate to for a trader?
It means acceleration. The analysis highlights that even a modest 2% bounce in Bitcoin's price translates roughly to a 4% gain in BITU.
Wow.
So if the technical bounce occurs as strongly as they predict, the gains in this ETF will be significantly magnified, and that's why the potential reward is so high.
Yeah.
But it also means you lose money twice as fast if you're wrong.
Right. So given that dramatic leverage, risk management isn't just important, it's like the lifeblood of this entire strategy.
Absolutely.
So we need to define the boundaries, because the whole trade hinges on the market respecting one specific spot. Where exactly is this line in the sand?
The analysis identifies the $21.50 to $22 range. That's the critical psychological and structural zone. This is the floor that absolutely has to hold for this bullish thesis to stay active.
And specifically, that hard support level is $21.55, the recent 52-week low. If that number breaks, the psychological barrier is just gone.
It's over. If the stock decisively breaks and, more importantly, closes below $21.55, the analysis warns that the entire structure collapses.
So we've seen capitulation, but without the reversal.
Exactly. And in that scenario, the market structure suggests it could easily touch $20. And because of the leverage, that move would be swift and punishing. Failing to hold $21.55 negates the entire contrarian thesis immediately.
Okay, this brings us to the central question of the report then. Why does the analysis argue that at $22, a risk-to-reward ratio is the best it has been all year, even after that painful 66% drop? It seems so counterintuitive.
It's all about quantifiable risk versus open potential. When the price was up at $60, the risk was totally undefined, right? It could drop to $50, $40, or, as we saw, $20.
Sure.
But now, having already suffered that massive 66% move, the easy money on the downside has already been made by the bears.
This is what you're saying is the probability of another major immediate drop, say another 50% from here, is statistically much lower right after hitting a 52-week low compared to the probability of a short-term relief bounce.
Precisely. The maximum fear has already happened. The risk, which is defined by the distance between the entry, say $22, and the hard stop loss, which we'll get to,
Right.
is very small. You are trading that small defined risk against a potentially large relief rally, a rally that could be 10% or more, amplified by the leverage. The reward is asymmetrical to the defined downside.
That makes sense. Okay, so the majority of the risk has already been squeezed out of the price. Now let's get into the specifics. For the listener who is interested in the execution of this analysis, we need the playbook, the concrete, actionable steps for a potential swing trade.
And this strategy, it demands extreme precision and discipline. Because of the leverage, you just can't afford to be sloppy with your entry or your exit points.
So the analysis identifies the optimal entry point, the buy zone, as between $21.50 and $22. That is a very tight 50-cent window right at the absolute bottom of the market's current structure.
And because that $21.55 sell level is so critical, the analysis insists on a hyper-disciplined exit plan for the risk side. They recommend a very specific stop loss of $20.90.
Okay, so why $20 Why not just set the stop right at, say, $21.50? Why do they need that extra 60-cent buffer?
That buffer is essential when you're dealing with volatile leveraged products.
Yeah.
If the $21.55 level fails, that 2x leverage will accelerate the losses down toward $20 much faster than a non-leveraged asset. The $20.90 stop loss protects the trader by getting them out of the position quickly before the price completely breaks down, while also giving the trade a tiny bit of breathing room. For those volatile wicks that might momentarily breach $21.55 without actually failing the structure.
So the necessary sacrifice.
It's a necessary sacrifice of 60 cents to protect against a several dollar collapse.
That's a fantastic distinction.
Yeah.
Okay, now for the upside. If this relief rally actually materializes from that capitulation wick, what are the targets they've identified?
2 critical resistance targets were identified. The first is target 1, $24.20.
$24.20.
And this is identified in the analysis as a gap fill area.
And for those who might not deal with charting every day, what does a gap fill actually mean in this context?
It basically means the price fell so fast during the panic that the trading volume didn't have time to build support at that level. It created a void, a vacuum on the chart.
And prices like to fill those vacuums.
Prices often snap back very quickly to fill that void.
And the beauty of that is that target 1 at $24.20, that represents a potential 10% move from the buy zone. And because of the leverage, that could happen incredibly fast if the bounce is confirmed.
Absolutely. And if the momentum is strong enough to pierce that first target and fill that gap, the analysis then looks toward the second target, Target 2 at $28. This is identified as a previous consolidation zone.
So that $28 level was likely a spot where the price kind of hung around previously, maybe built some support before the final crash.
Precisely. It was a structural support level in the past, but once the price breaks below it, that prior support flips roles and it becomes powerful resistance on the way back up.
A natural place for sellers to show up again.
Exactly. It's a natural place for bears to re-enter and for traders who bought the low to take profits.
Okay, so the overall objective here is a swift swing trade, leveraging that 2x factor for move back toward the $24.20 gap fill, and maybe even reaching $28. But the entire high reward scenario is completely dependent on the market respecting and holding that hard $21.55 floor.
Right, with the $20.90 stop loss serving as the final absolute safety net, it is a fundamentally binary setup defined by a few pennies. Hold $21.55 and you are positioned for a high probability bounce.
And if you fail to hold it?
Fail to hold it, and the downside pressure, amplified by that leverage, is immediate and severe.
We've covered the complete arc here, from the emotional crash, that 66% drop, to this highly calculated, precise setup. The entire thesis rests on the confluence of maximum fear and extreme oversold conditions, creating this moment of potential opportunity.
And what's really fascinating here is that this whole strategy, it's predicated on catching the exact fleeting moment of market capitulation. They're betting on technical structure, overruling mass emotion.
And that raises a really important question for you, the listener, to consider. I mean, especially when it comes to the psychology of trading.
This is the ultimate test of discipline. What does it truly take to trust a technical signal, this idea of a capitulation wick and a $21.55 floor, and, load the boat precisely when the entire market is confirming your worst fears?
Yeah, when every headline is screaming crash.
You are trusting one single number. It forces us to ask whether structure, that defined support level, and that optimized risk-reward ratio can genuinely trump the overwhelming emotion of a panic sell-off.
It's the ultimate battle between logic and crowd psychology. We've laid out the playbook, the risks, and the targets based on this deep dive analysis.
And we really encourage you to continue exploring the fascinating dynamics of leveraged ETFs. Understanding how defined risk management works in these highly volatile environments, especially when they face extreme 52-week lows, is just key to navigating assets like BITU successfully.